Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, January 17th, 2020. In this video, I want to do a kind of a big picture overview of the U.S. stock market, and what we're going to do a little bit different this time. I usually focus mainly on price, because to me price is the most important thing, and that's when I talk about price, I'm talking about price support levels, resistance levels, trend lines, things like that. But what we'll cover in this one are a few different other things. We'll look at some trend indicators, moving averages. I'd like to touch on market breadth and sentiment. So I'm going to go over those charts. Some of those I may even add below the video or follow up in the comments section with some screenshots of those charts, and maybe even a couple links. I can give you guys links to those charts from stockcharts.com. That's usually the ones other than these black charts. This is TC2000 here. All right, so let's start out with this. Oh, by the way, we're going to stick with QQQ. Not that QQQ is it's not the stock market. In fact, it's considerably less diversified than the S&P 500, for example, as far as sector weightings and number of stocks. However, it is very tech heavy and technology. Make no mistake about it. So those big market leading FANG stocks. You have, I think, what was it, Alphabet the other day just joined the $1 billion club, fourth company in history to cross that mark. Those are what's lifting the market. They're also the top components of the S&P 500. And so make no mistake about it. When tech breaks, the market breaks. It's just no two ways about it. So if we look at the tech-heavy QQQ, where that goes, the rest of the market's going to go. There's just very, very, very little doubt in my head about that. All right, so we're going to start out here, and I'm going to work my way down on the time frames. This is a monthly chart. That's about the longest time frame I go out to. What that means is every candlestick represents 1 month of trading history. You can see the year breaks down below here. So we're going back decades on this chart. And plain and simply, you can see you have on this chart, it's pretty clean. You have trend lines, and then you have a blue dash line, which is the 20-period exponential moving average. So since it's on a monthly chart, we'll call it the 20-month EMA or 20-month exponential moving average. And that is in my opinion, one of the best trend indicators, long-term trend indicators out there for not just its accuracy, its track record, but also simplicity. I mean, you have one single line. Some traders will use moving averages, incorporate those into their trading, and I've seen people use 2, 3, even 4 more different moving averages, looking for crossovers and different things there. But again, so I give an extra weighting to something when it's simple. It's easy to spot, a lot harder to miss the sell signals when you get them, or buy signals. And so let's start there and just take a look at it, and I'll show you why I like that one. I've covered it many times in the past. It just does a phenomenal job of defining bull and bear trends, the primary trends. So this is your 401k long-term investor stuff. And what I want you to note too on here, if you're new to technical analysis or trading, I prefer candlestick charts. In most cases, it depends what I'm looking at over line charts. And on a candlestick, whatever time frame I'm trading off of or viewing it and using my analysis, in this case it's a monthly time frame. All that matters, the most important thing I should say, is how that candlestick ends or closes the month. In other words, here back in 2015, we had a little flash crash. It took the Qs way down, but then they snapped right back. Even that day, most of that tail on that candle, the shadow down below, you call it a tail. If it's a shadow, or the skinny part above, it's a wick. So most of that tail happened just one day and it snapped back. And again, you can see numerous tails down below there, but in each instance, or most instances I should say, not all, most instances you close back above, and that's the important thing. So for a sell signal, you want to see a solid monthly close below that 20-month EMA. And again, you can go back in time, just if you're not sure what we're looking at, here's the year break. So there's the dot-com bubble. Boom, shortly after the top, you had a sell signal. You stayed below that throughout most of the bear market, so it got you out of your longs or into shorts most of the bear market. The bottom was in 02. It took a little while. I'll say this, the longer the time frame you're trading off of, the slower the sell signals are. So it's not going to get you in right at the top, or in at the bottom, I should say, after a bear market, or not going to get you out at the top of your longs. But it will do a very good job of defining the trends and help confirm what the primary trend is, as well as maybe get you in and out of your 401k money, that kind of stuff, long-term stuff. The shorter term charts give you the faster signals, and we're going to work our way down to the 60 minutes. But the downside is, the flip side to that is, you have a lot more whipsaws on the faster charts, the shorter term charts. So this one, very few whipsaws. Nothing's perfect. If you comb through here, replicate this on your own charts, you'll see once in a while during a trend you had a monthly close below, but in most cases it wasn't very impulsive. So what I like to do is align two things: the trend, the primary trend line. Remember, in the dot-com bubble, well, maybe you weren't around then, we had a parabolic run, a blow off top. This was our uptrend line heading in the 90s. That was, up until this bull market, the strongest one in history. Longest one, I should say, and I believe strongest. And at that point, we started going parabolic, and that's usually what happens during a parabolic advance. Even though I'm using log scaling, if I wasn't using log scaling, it would be even worse. This is what the chart would look like. You get a distortion in price. So when using long-term charts, I highly suggest using log scaling. Why? Because it puts everything in equal percentage moves, not price. Because when you have a $10 stock or index, if it goes up $1, that's a 10% gain. When that same index or stock is at $100, a $1 gain is only a 1% move. That's 10 times stuff. So that's what log scaling do. It'll correct that for you and paint a picture, overall performance. Because it doesn't matter, hey, if you made $1 on your stock, great if it's a $10 stock again, but not a big deal if it's a $100 stock. And so that's why I like to use log scaling. So there it is, very simple indicator, and you can see even lately, look at all these breaks, and it's just doing a bang up job of trading above there. You also have a well-defined bull market uptrend line. The Nasdaq is the only major index that bottomed before March of 2009. Everything else, S&P 500, the small caps, mid caps, the Dow, they all bottomed in March of 09, but the tech heavy Qs actually had technically hit their bottom back in late November, sometime in November of 08, but either way, and then had a second nearly equal low back in March of 09. So there it is, and you can see a well-defined trend line. So to make it very simple, and we'll move away from this one, I would not be able to say without a high degree of confidence or certainty that a new bear market is underway unless this trend line goes and that 20-month EMA. They come in perfectly together, and that's quite often the case. You've seen that in past bull markets or bear markets. There was an uptrend line. The uptrend line and the 20 got taken out there. You had a kickback rally, back test. After you back tested the trend line, they back tested the 20-month from below on 1, 2, 3 candles there, and after falling back below it right there. So 1, 2, 3, boom, gave it up. And that, again, that doesn't look like much right here, but that's the Great Recession right there. That's the drop. There's a 55% drop from high to low. And even if you waited to the sell signal game, you still caught the bulk of that, or at least you got out of your long. So that's it. To try to put things in perspective, let's look at how much we have to drop just to get down there. I can tell you it's about 16%. I'm not grabbing the top of the candle, but I'm even with it because I don't want to move that trend line. That's what this charting software will do. So let's just say that we had from here, we reversed and dropped sharply over the next, few weeks or month or so. You're looking at about almost 16% just to get to test those dual support levels. So keep that in mind. We'd have to drop more than 16% and then close a month below to have what I call a high probability sell signal long term. I talk about sell signals. Don't confuse if I'm trading a 5 or 15 or 60-minute chart, a short term or near term sell signal with a long term sell signal. It's the 60-minute charts that are going to help us determine when we're likely to head down there and test that, even the daily chart. So let's move away from that one. Negative divergence is still very much intact. Bull market still solidly intact by nearly all my long-term metrics. It has to be. We're at all-time high. There's no way if you have any technical tools that are telling you it's not a primary trend, they're not working. Wouldn't make sense, right? All right, so let's look at the weekly chart. Weekly chart, I have several different drawings on the weekly. I have to find the one I like. There it is. We can look at that trend line right there. That's probably the most important on the weekly chart, and that comes off that bottom back in late February, in February of 2018. That is. I'm sorry, February. I'm talking December 18. So there's one trend line. It's not super well defined. Let's come down to the daily chart and take a look at that. See what we got there. All right, so the daily chart right now, here's the trend line. This has enough reactions, this one right here. Let me color code it for you. And that comes off the lows right here. I think it was October 3rd, if I'm not mistaken, early October lows, and it's pretty well defined. So that's the one we need to watch. And again, if I can grab the correct line tool here, that's it right there. So you can see quite a few reactions. We're comfortably above it now, but remember, you're going to get a sell signal first on the shorter term 60-minute charts. We'll jump to those real quick, and then I'm going to go over a few things that I haven't shared with you recently. All right, so this is it. And remember, I talked about it the other day with the FANG stocks. You know, we keep diverging higher, but the divergences are still intact, and they're starting to actually steepen here. What do I mean by that? Well, we had this divergence. We had a divergent high right here. And if I extend that line out, it goes over here. So you can see the indicators are now starting to lag at an increasing rate. Lag against prices there, and so you still need this uptrend line right here to crack. There it is. We'll call it the yellow uptrend line. That's the most important level. That was an important level from a few weeks back. Remember, we tested that the night of the Iranian missile strikes. Right there, we hit that 211.42 in the after-hour session. It's not showing here, and it held. That was at the time my key level. That's why it was yellow. And so again, like I said, they've been buying pullbacks to support. So now we need this one to go, and I can even give you a little micro level right here on the 60-minute chart. I think that 221-ish level, and it comes in right around the same. So let's watch that. Okay, and I talk about divergences all the time and how most of the major drops in the market come following divergent highs, and most of them, not all, but most of the major bottoms come on a divergent low. This was a divergent low. You had divergence down here on the RSI down below. See prices making a lower low and the RSI making a higher high. You didn't have it on the PPO, but sometimes you get on one indicator, not the other, and that certainly was the case there. Let's turn all these lines off for a second, and let's even park these two indicators and look at something else, because I cover these all the time. They're obviously my go-to indicators, the PPO and the RSI. Let's add in, I want to show you, see a couple other things, some custom indicators I created here. And I have the percentage stocks above the 50-day moving average. We just added there. And nope, that's not it. And where's my other one? Got a lot of indicators here on the side. Here we go. It should be this one. Yep, percent above the 200-day moving average. So what we're looking at here. Okay, I wanted to make the 200 red. That's the color of my 200-day moving average up on the chart. So I created a custom histogram. I'm sorry, not a custom histogram, custom indicator. And I can show you how I did it real quick. I added a, I did it this way, add chart plot. I added a PPO. If you use TC2000 or free stock charts, type in price or price percent oscillator right there. PPO, hit it there. Then go in, get rid of the, you don't need the signal line there. You want to go in here, change the settings on the PPO, change a short period to 1, and then this to whatever your moving average is. Let's say you like to use a 100-day moving average. Let's say you like a simple moving average. That's it. And what this line is now going to show you is the percent, right here is your value, that prices are trading above that particular moving average. So I use, and I think, I know other traders use that too. It's these features are available on stockcharts.com. I don't think TC2000 has them, so I had to make it custom. And so you can see it there. Here, I'll tell you what. Here, turn on the line right there. You can see the 200-day moving average. And if I measure it, grab it right there, and measure up to where we're at now. If it snaps to it, I've got to probably zoom in a little better to get it to snap to price. But it'll show you the percentages there, about 14. If I'm not right on it, but it should match what that red line down below is at. So that is 14.76, close enough. I'm not snapped to the current price, but you can see right there, 14 something percent. All right, so let's go back to where we were here. So I had to add back the 50-day. I had another 200-day up there. And so what I'm going to do here is add a trend line or a horizontal line to just kind of measure the highs and show you the extremes. So when we roll back through here, you can see the Qs on top hasn't hit this level. In other words, it's the farthest above its 200-day moving average, the highest level that it's been since right here at this point. The last time we were at that level, I'll zoom in a little tighter, you can see In fact, I'm not exactly on it, so either way, close enough. You don't have to be to the exact put, but that's it. So we're right there, and that was just before a drop of about, and we had similar conditions, divergent high, everything else. We had just rebounded off a correction. That was good for about a 13% drop from there. So I'll turn those lines back on. I just wanted to point that out, that we have extreme conditions right now in the market. Price action is about as bullish as it gets lately. In other words, they're buying dips aggressively. Just about all stocks and sectors are rising with it. But again, when you hit this level, and again, I didn't measure that one, that looks even like a bigger drop there, at least 12, 13%. So you're going back for years. You usually do not see the markets, in this case, the Nasdaq 100, that far. In fact, I went back for years there. You can see here, and that's the only other time that it's reached this extreme level. So again, it just means to me the risk reward isn't very favorable. And as I say, quite often you usually will see weeks, if not months, of gains wiped out in just a few days during these corrections when you have these extreme levels. Let's look at another thing here on the 50-day. I'm going to put a line about where we are right there. You can see, my line might be a little bit above current price. That says 6.18 where we're at right now. We were a little bit higher there before. So in other words, we're a little shy of 7% above the 50-day moving average. Remember, a 50-day is a faster moving average, and I like to use the exponentials. They calculate faster than meaning they respond to prices a little faster than a simple moving average. You can use either. Some traders use some. I'll look at both. Whatever line's fitting better is the one I go with, but I like to leave these on my chart. So there it is. So here we are, boom, at that level right now. Last time we were here was right here. The time before that was right there. That didn't do much, but it was a little check. We had a little pullback, thrust, another thrust up, and we hit it again. So the takeaway, a lot like the divergences I talk about, they're not sell signals. Extreme overbought readings are not sell signals. Percent above your key moving averages are not sell signals, but they are a heads up that, hey, things have gotten ahead of themselves. Things are pretty stretched, and the odds for a significant correction are pretty high right now. Okay, I had to pause the video there for a brief second so you get the picture, and we'll look at one more here. We'll jump out to a weekly chart on QQQ. Forget about all the trend lines here. We'll just go back to that. That's a little more clean. And do the same thing here. Let's park the PPO and RSI, get them out of the way, and put up the I like to use a 40-week. Now the 40-week is above is the same as your 200-day exponential moving average on a daily chart, because there's 5 days in a week. So if you take 40 times 5, that's 200. And so but it does a great job, and on a weekly chart you can usually go back a little more. It does a good job at defining the uptrend as well, particularly in QQQ and a lot of tech stocks like Apple. Not as perfect. You'll see some whipsaws, but for the most part, as you can see here, and again, these are a little bit shorter term trends. Remember, I started on the monthly chart showing you the primary overall secular trends of the market. These are the trends. There's been plenty of corrections which were profitable to trade or profitable to get out of if you were long, to get out of your longs and then buy them back in at a better price after a correction. You can also see the bull and bear markets there. So there's your drops below. And I just wanted to show you here, no surprise, because again, it's going to be similar to that 200-day, that we're pushing extremes that, and if you replicate this chart, you can see, even if you didn't correct right away, like back here, this was 2011, and you hit this extreme reading, the market didn't drop right away, but guess what? It didn't go up either. It went sideways for months, about 6 months. Then it corrected about 10% or so, maybe even more than that. And back here, there was a recent extreme reading, and you actually had divergence right there. You had a correction. Let me move that line, tell you how much that was. From there we dropped roughly 12.3%, pushed up, made a marginal new high, and dropped another 12% right there, back-to-back overbought readings. And the divergence continued, and then boom, finally the big one came. That was at 20-something% plunge back in the fourth quarter of 2018. So there we are. We're not as high as we were on that first reading, but we're above that one. We're in between the two. So maybe we get a little check pullback first and then another thrust up. Maybe this becomes more overbought, but as you can see, go back again throughout time. Usually that's about it. That about caps the level, and again, that's where the odds for correction get pretty high. And then finally, monthly chart. I'm not going to scroll back to the .com days because again, the QQQ, the Nasdaq had a different makeup. You know, the .com bubble back in 2000 was mostly, as the name implies, about those .com stocks that had virtually no profits. Most of them didn't even have a business model or proven management. They just had the name .com somewhere in there, and people were buying them just because of that. So we saw, you know, the Qs got really whacked to the upside, and then, you know, really, you know, hit hard on the course following. So we're going to go back just since that time, and you can see, and that still captures the last bull and bear market before that. So that's it. Here's where we're at right now. We're right about the 20 level. There, I put a white line there for you. That was the top right there of the bull market that ended in October of 2007. There's your 55% drop that came after that. The next time we hit that level was right here. Again, doesn't look like much on here, but that's a double-digit drop right there, and that marked the top right there. We hit it again right here, and I could measure it out, but sometimes you got to zoom in to grab these candles. It was still a, you know, what is that, 12.3% or whatever. So another double-digit correction. I get the point. Now, here's an instance where we saw very little, at least on the initial tag, but we stayed persistently overbought there, you know, above the 20-month moving average. And what happened, it finally we started to diverge, you know, that negative divergence, and it played out for the flash crash. The QQQ fell over 20% in a day. The actual Nasdaq 100 didn't. I remember I was trading it back then. The index, it didn't, but because of the, you know, flash crash that happened on many individual stocks, including QQQ, which is an ETF, tries to track. That was the actual drop. You can see it there. So again, what happened, the persistently overbought readings played out, and that's what I like to say is, you know, the more overbought, the more extreme the market gets, usually the bigger the ensuing mean reversion, whether it's to the downside during a bear market or, you know, to the upside during a bull market. So that's it. And you can see since then, that was again a bear market in many sectors and indexes back in 2015, 2016. Markets traded almost 2 years sideways after couple big corrections within, and that was again the last time we were there until, of course, 2018. We hit it. We had a big drop in early 2018, if you recall, back in January. It doesn't look like much on here. It was pretty quick, over quick. Then the big 20-something% drop. So that's it, guys. And this is why, yes, the trend is resilient, and it may continue for a while. Like I said, you know, overbought can become more overbought in this case, you know, or the Qs can get higher above that 20-month EMA, but at this point, the risks are substantial for a sudden reversal. And one of the reasons I wanted to do this video, again, is not only to get these levels out to you in advance, you know, trend lines, price levels, moving averages to watch, but also I think if there's going to be a catalyst, you know, a missile attack on 2 U.S. Military bases, if that didn't stop this rally, the only thing I think is going to stop it is a disappointing earnings season, and that is coming up. In fact, I meant to do that too. I'm digressing here. I might even have to break this video down, but I want to show you something real quick, what we have coming up here about the market leading stocks. Apple, January 28th. These are earnings dates. That's after the close. Microsoft, January 29th. Amazon, I know I put it in there, January 30th. Okay, so there it is. In just a couple weeks here, we have Alphabet I have in class. I already did the Class A shares. There it is, February 3rd in Alphabet. Facebook, January 29th, and Intel, January 23rd. Those are the top 5 largest holdings in the Nasdaq 100. Most of those are also the top holdings in the S&P 500. So in my opinion, if there's anything that's going to turn this ship, other than, of course, a black swan event. You can't predict black swan events by nature. You don't know what they come out of nowhere. I think it's going to be earnings. And again, the charts are certainly setting up that way right now. I posted this setup the other day on Intel. So there it is. We're just a couple weeks away. And let's see how once those 6 stocks have reported, I'm pretty sure that will most likely set the tone for the market. If they happen to come in and beat what are already probably hugely inflated expectations, and they give rosy guidance, who knows? Maybe we do get a blow off top in this market, something like what's going on with palladium right now. Otherwise, it could be the catalyst to the downside. Again, the charts are indicating sooner than later this ship will turn, but right now, no sell signals, and I promised to take it down all the way to the 60-minute. No, we already did that. I already covered the 60-minute chart. So we're done. We're done with what to look for as far as, you know, sell signals. Until then, we're just, you know, we've been grinding higher, so you need to see these trend lines break on the 60-minute charts, each of these levels, and then at that point you start to get the sell signals, and if the market starts to go down, then I turn my focus out here to the daily charts. What happens when we get to this trend line? Do they step in and buy it with another thrust up, or do we hit it, maybe get a little minor reaction and break it, or do we just smash right down through it? Anything is possible, so those are the levels I'll be watching. What I think I'll do, I'm at the 25-minute mark, and I really wanted to go over some breadth and sentiment indicators, and there's quite a few. So what I'm going to do is cover those in a separate video. I'll get this one out to you, and then follow up with that one later. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.